Another rocky day in the market as we see Nvidia down 5% as well as others right across the board. We have information coming out that Microsoft are probing to see if DeepSeek in fact did obtain the data improperly for their AI system. We actually note OpenAI, who have said they've got evidence to claim that DeepSeek used their model to train their competitor. But actually what we want to focus on today is Alibaba, who have come out now and said they have a new Qwen model that outperforms fellow Chinese company DeepSeek on various benchmarks. Now, before we get into the article, we will just highlight the company itself is up around 4% today, now trading at $100, and we do believe this clip can set us into the episode nicely.
Alibaba's just dropped their latest version of Qwen 2.5. So this is DeepSeek followed by Qwen. This is now a much bigger issue. It's not just about China, US. This is about open source versus closed source. What are they promising at Alibaba?
Yeah, that's right. So, I mean, I guess this kind of plays the point I just said that, you know, that the AI market is evolving at a really rapid pace. And, yeah, we've seen this with the Qwen model. I think right now it's too early to say, but obviously the headlines from Alibaba that this new model outperforms the DeepSeek model across a whole range of kind of industry standard benchmarks now. There's a lot of gaming of these benchmarks, so I think we'll have to wait perhaps a matter of hours or days whilst engineers get their hands on this new Alibaba model to see how it performs in real life. And what you tend to find with these large language models is that some of them are really good at very specific things like kind of complex maths computation. Others are much better at natural language and, you know, kind of giving really human-like textual responses to questions. So I think we'll have to see how good it is in real life.
Now, we can also see from this information, again, it does need to be verified, but that Qwen 2.5 Max does, if not in a lot of metrics, outperform or have a very similar performance. If we go back to this article, we can talk about a few different things. The first one, they've come out and said that Qwen 2.5 Max achieves competitive performance against some of the top tier models that we have just showed you, and in fact they say this includes recent releases from both Microsoft-backed OpenAI as well as the Facebook parent Meta platforms. On top of that, they do say it outperforms the DeepSeek's V3 AI, and remember just a few days ago DeepSeek came out and said that it only cost them around $5.6 million, something that is yet to be verified, and a lot of issues that have arisen from this point. And whilst Nvidia itself is down, as we showed you, around 5%, Alibaba on the other hand is looking very promising. And a few other notable mentions. The first one is that Alibaba has not yet shared information about the cost of production of Qwen 2.5 Max, something that we actually saw with DeepSeek, that they mentioned 5.6 million. Again, something that is very questionable at this point in time, and they haven't yet made it open source, something we could see in a few days, and this would essentially mean they'd have to release the information about the numerical parameters that has been used behind this model. So definitely an interesting day in the market. Alibaba itself though up around 36% over the last year. Over the last 10 years though only up 17%, as we can see still some way away from nearly 5 years ago where its all-time high sat around $307, although right now it is trading at the upper end of the 52-week range. Both Seeking Alpha and Wall Street consider this a buy, although Wall Street's buy at 4.46 isn't far off the 4.5 that would switch this into a strong buy, and we can also see they do currently pay a dividend of around 2.08%. If we are to look at Alibaba as a company, a quick analysis as well as our own valuation of where we see this company, over the next 4 quarters, they do expect growth quarter on quarter in comparison to last year, and over the last 4, in terms of a historical performance, they have outperformed on 2 of them, in fact the most recent, giving them a 50% track record. And we look at the EPS for March 2026, this means their forward PE right now sits at 9.82, and if we were to compare this, as we can see they get a C against others in the sector, they actually trade significantly lower, around 38%, meaning it is at a discount. Question is, some companies deserve to be trading at a discount due to poor underlying metrics. Is Alibaba one of those, or are we spotting a golden opportunity? And we can also see in comparison to their 5-year average, they are trading lower by around 30%, something we do see pretty much whatever metric you do use. Alibaba as a whole is trading significantly lower than the sector comparative. On the growth stage, they get a D-, Not great when you look at their growth over the last 12 months, 5% above the sector, but significantly lower than their 5-year average of 20.3, and the same conclusions to be said about the next 12 months, above the sector median 6 versus 3, but significantly lower than 19% from their last 5 years, although one thing that does look very strong for them is the future, again if you believe the numbers. 18.5%, well above the 10.4 of the comparative, as well as being above the 12.7 they have historically reported. Profitability looking good with an A. Gross margin coming in at 38%, pretty much in line with both the sector as well as not far off the 5-year. Bottom line 9% above the sector but below their 5-year of 14.7. Cash from operations very high at 22 billion, well above the 267 million of the sector comparative, and we also note it is lower than their 5-year of 27 billion. Nonetheless, still looking very good. As we said, a double buy from both Seeking Alpha and Wall Street, a C on valuation, D- on growth with an A+ on profitability. If we were to look at the institutions, we do see around 13.5% ownership, around 3 billion worth of sales over the last year, but a lot more buying during the same time frame. Whether or not though that does give you confidence, always do your own due diligence, and we should point out over the most recent quarter, institutions have been selling quite a lot more than they have been buying. In terms of the actual quality of the company, we can just touch upon the free cash flow payout, given they do pay a dividend of around 2%. Over the last few years and expected over the next 12 months, around 12%, which does give us faith if they want to, they can increase the dividend at a double-digit rate. Free cash flow, where we do want to see consistent growth over the long term, not too bad. It is expected to pretty much increase, although very marginally, over the next 12 months. In terms of sales growth, definitely looks like the growth story of this company has come to an end. 45% 10 years ago, 8% in 2024, and 5% on a trailing 12 month. So it has been a number of years since we have seen double-digit increases on their top line. But from a numerical point, if you do stand back over the last 10 years, it has grown significantly. In terms of shares outstanding, we want companies that return excess cash through share buybacks. Now, a net position over the last 10 years, it has pretty much not moved that much. Some years they have increased, diluted your position. Other years they have in fact done share buybacks, but right now very minimal difference from 2015 to 2024. And ROIC, while we want to see around 10%, it is a little bit inconsistent, but pretty much there or thereabouts in 2024 and on a trailing 12 month. Then we have to talk about the margins. In fact, both operating and free cash flow are above the minimums we want to see. The only negative we would say, we actually get operating deficiency, where it has been decreasing over the last 10 years as revenue has been increasing. Same to say about the free cash flow, but as we did say, they are still above the minimums for the industry. Net debt to EBITDA, very impressive, probably their best metric, where we do see 0 right across the board and over the next 12 months, meaning it won't even take them 1 day to pay off all of their debt net of cash on hand. Definitely a strong balance sheet. Now, we already covered their top line revenue growth, as we can see, very impressive, although the growth has been slowing down. We want to just show you the bottom line net income, what story is to be told from this aspect, and in fact very inconsistent. Whilst the revenue for the large part has been growing very rapidly, their bottom line net income incredibly inconsistent. We see around 4 billion in 2015, now at around 11 billion, but we can in fact see 2020, 2021, that was a lot higher, in fact more than double the last 2 years. Something though just to consider. Then we look at the balance sheet, as we already showed you, very strong. It won't even take them 1 day to pay off all of their debt, but a very quick health check, we do notice their cash has been rising from around 20 billion in 2015, 55 in the latest quarter, and don't forget we do compare this to the total debt numerically and directionally, which as we can see here over the last 10 years has been increasing and quite consistently. 8.5 billion in 2015, 33 in the latest quarter, but one thing we do like is that their cash position is far superior, does reinforce that it won't even take them 1 day to pay off all of their debt net of cash on hand. And in terms of the cash flow, we just want to see the cash they do generate, and it has been increasing for the large part, going from around 6.6 billion to now sitting at 22 billion on a trailing 12 month. So how's this company performed against others of a similar size in a similar sector? We have PDD Holdings, Mercado Libre, as well as some very well-known options. In terms of over the last year, including dividends reinvested, actually one of the better performers, as we can see, up 38%. If we expand this to the last 5 years, actually one of the worst performing and negative, in fact negative 51. And then when we go all the way to the last 10 years, very poor at only 20%, again one of the worst performing. Point here though is to understand that the past performance is not an indicator of the future. They could perform a lot better, could also perform a lot worse. And for those that want to see the comparison against the S&P, they actually outperformed over the last year, 33% versus 23%. When we expanded over the last 5 years, massive underperformance, no surprises there given the negative return. And over the last 10 years, again, massive difference. S&P, considerable outperformance. Again, just some things to consider. Now, before we jump into our valuation, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning where we talk about severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January. Lots of information for each one, the upside that Wall Street themselves see over the next year. We are also dropping a new copy for February in the next few. You can grab a recently released copy of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now jumping into the valuation, we have a $150 intrinsic value derived from the DCF model. You can see the free cash flow year on year, average growth around 20%. Now we've wanted to be very conservative at the 0% rate, and with the discount rate we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, and we can see here $150, which does indicate 50% upside. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alibaba or any others, but we'll show you here at 2%, $172, indicating 72% upside, and at 4%, if you can see that over the foreseeable future, just under $200, that is nearly a double from the current trading value, 97%. Now, we want to be extremely conservative today, so we have gone for 0%, which we do take through, and we always like to use a margin of safety. Now remember, for those that have forgotten, we start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $135, then we keep going till it's near the current trading price, and up to $105, you're getting 30%. For 35%, not too far off, around 98, but at least 30%. With Wall Street, as we said, not far off a strong buy rating. They see this priced at $122. It could go upwards after today, the release of the news that we discussed, but at the moment, this does translate to 22% upside by the end of 2025. As always though, do give us your thoughts. Maybe this is one that is back on your radar, maybe this is one you don't like for the geopolitical reasons, or there are other reasons, as we have heard, that people just don't want this in their portfolio. On the flip side, other people will like this, maybe see the 30% margin of safety as enough for some of the risk that does come along with this company and this region. But as always, let us. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have been buying over the last few days, so do come and join. And as always, have a great day. We'll see you all on the next one.